Hi, I'm Jeremy Johnson, CPA, and today we're starting our Strategically Planning for Your Future series. In this first installment, we're actually going to cover retirement vehicles. So in planning for your retirement, depending on your work status, there are a few different types of retirement vehicles that you can use to prepare for your future. The first one that we're going to cover today is the 401k. This particular type of retirement vehicle is one of the most common, and it's what's considered a defined contribution plan. Now, what that says is that the employee contributes a dollar amount or percentage of their income and is usually matched by their employer at times, which is a huge benefit. So that defined contribution just comes in the terms of there's 5% of your income that's going to be going into this particular plan. And through the plan, the company actually invests on your behalf. And so again, it's always great if your employer is one that does match. And I always advise clients, if your employer is willing to match what you are putting into this particular plan, max it out. Take full advantage of this benefit. It's kind of an easy way to give yourself an annual increase in your pay. You don't see it up front, but in the end, it all pays off. So this plan also allows you to save for the future and save on your current taxes, as tax savings are immediate. When you contribute to this plan, you're already receiving a tax benefit. If you look at your W-2, in box 1, you'll actually see where it says wages. And then you'll see where it says Social Security wages, and you'll notice that sometimes those wages are a little bit higher. Well, your taxable wages have been decreased because you are contributing to a plan. So it's a great way to get immediate benefit there. Now, when distributions are made, they're taxed as income. Okay, so just keep that in mind when you are able to take your distributions in the future, once you retire, that is going to be taxed as income for you. Now, one of the things that you need to do when trying to set up a 401k or any retirement vehicle is you need to review your budget very, very carefully, because one of the things that you want to avoid are loans and early distributions. And right now, there is a standard 10% penalty in place for any early distributions of your retirement vehicle, whether it's a 401k or IRAs that we'll get into here shortly. So just be advised that that's one of the things that you really need to keep an eye out for. So make sure you look over your budget and come up with a dollar amount that you can invest or that you can contribute that makes sense for your household. Another thing that you want to look at is you want to be able to review your allocation based on your life stage. Now, what is allocation? Well, allocation is basically where you have a certain percentage of your retirement fund that is going into some type of other fund. And basically what that is you may have 75% going into a high risk investment area, 25% going into a low risk investment area. You want to invest in riskier funds while you're younger, and cash or bond based funds when you're closer to retirement age, because you need that security. Now, you want to consult your plan administrator or your financial planner to help you with your allocations. Okay, if you're not well versed in the market and investments, please consult with a professional so that you can do what makes more sense for you personally. Now, the next retirement vehicle that we have is a 403b, which is the equivalent of a 401k for public education, for the public education system, or some nonprofit employers. It's pretty much the same framework as a 401k, and it's also considered a defined contribution plan. It's just for a different industry, but that's the 403b. So for you educators out there, be sure to look into that 403b. Now we're moving into the individual retirement account, or IRA. Now, this is typically used when a 401k is not available or you're self-employed, but it can also be used as an additional means to save while you are employed. So the two most common are the Roth IRA, and then you have the traditional IRA. Now, the Roth IRA allows you to contribute after-tax dollars and make qualified withdrawals tax-free in most cases. And so what this says is you're basically taking money out of your pocket, out of a savings account, and you're dumping it into a Roth IRA plan. And so it's able to grow tax-free. And then once you are of age and you're able to make qualified distributions, that money comes out tax-free to you in most cases again. So the next one that we're looking at is the traditional IRA. Now this allows for tax deductible contributions dependent upon your income, filing status, and other factors. So basically what this is that you can actually contribute to your traditional IRA, and those contributions can be taken as a deduction on your tax return. But again, we have to look at your income, your status, and other factors. Now, distributions are treated as ordinary income and are subject to taxation. Now that's because you received benefit on the front end, so you were able to contribute and take that deduction. So then when you actually take those distributions, that's going to be treated as ordinary income. So please keep that in mind. Now, based on your age, income, and other factors, there's always other factors, contributions are limited for the traditional and the Roth IRA. Now, individuals over 50 are allowed to make additional contributions, and these are called catch-up contributions. Now, for 2013, that dollar amount is $5,500. Now, keep in mind, these are tax numbers, so they do change at times. So it may go up to $5,600, $5,750. We just don't know, but just be sure to consult with your financial planner or your tax advisor to kind of keep up with those numbers for you. Now, if you want to discuss anything else specific to you, let's set up a consultation. Shoot me a message in my inbox. Feel free to give me a call, visit my website, and let's set up a consultation and see what we can do to get something set up that makes sense for you. The main thing is really sitting down and establishing a budget and establishing a dollar figure that you would be able to contribute. And then also, I can refer you to the person that I use. This person has helped me with my retirement account. I actually used them for my life insurance and everything. So yes, CPAs have financial planners as well, because there's only so much that we can do. So there's someone that I use who's been a great resource. She's been a great asset to my clients. My clients love her. She's very prompt, so I can always pass that information on to you. Now again, this information is very high level. There's a lot of detail that we can go into that is very specific to you in your case. So send those questions to me and we can address those as well, maybe through another video. And what I've discovered in piecing together this particular video and pulling information together is that there are so many factors that need to go into planning for even just retirement. I know we're talking about your future overall with this entire series, but there's a lot that goes into your retirement planning. So I'm pretty sure I'm going to do a follow-up video to this one. And in that one, I want to discuss how to establish what you can actually contribute to your retirement fund. We kind of did it at a high level, just said, check your budget. But there are things that you need to consider, like your lifestyle once you retire and your current lifestyle, where you are now. Are you able to contribute $500 per month, $200 per month, $50 per month? Have you set up your emergency fund? There are a lot of things that go into that, so we'll cover those in another video. But in the meantime, please feel free to share this video with your friends and family, and also don't forget to like Jeremy A. Johnson CPA on Facebook for more tips and advice. And we'll see you next time. Thank you.